Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. My next guest and I both attended the Exchange conference, and obviously the number one topic there were trends impacting the ETF space. Well, my guest is an expert in the ETF space and has some great insight about the recent innovation in ETFs and maybe what that means for the space and investors. But first, today's episode is sponsored by the award-winning Zephyr, which helps financial investment professionals make more informed investment decisions. I'd like to welcome Ben Fulton. Ben is the CEO of Webb's Investments. Ben, great to see you again. Thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Webb's Investments?
Sure. Thanks, Ryan, and thanks for inviting me on. And it's good to see you earlier this week. So I personally, I entered the ETF space almost 30 years ago, and probably most notably, eventually I ended up running the Invesco Global business, ETF business, and later oversaw the ProShares Tactical ETF business, all the levered and inverse businesses. Did some consulting and other type of thing in between. I came out of consulting, we'll say a little maybe semi-retirement, with this idea of webs when we really started realizing volatility was one of the concerns in the marketplace, that people were having a hard time. How do I deal with this? How do I address this? Yeah. Or do I have to give up all my upside to get the protection I need? And we think we've come up with a way that people can have their cake and eat it too. Let's help you manage risk, smooth out that experience, keep people invested, but still maintain or maybe even enhance your long-term returns.
Yeah, it's fantastic, and so important. And we'll talk about this shortly about, limiting that drawdown or that, drawdown loss so you have more assets to capture on the upside, right? It's so important. you know, During this past week and over time, there are over 4,000 ETFs available. Last year, I think I heard over 700 new issues. And of those 700, 550 were active ETFs. How does that impact the space and investors? Do you think that's a good trend moving forward, or is it sustainable moving forward?
Well, I think it is. It's interesting. Numbers, what's the old thing they told me first day of statistics? Numbers don't lie, but liars can, factor. So active, passive in ETFs is probably a misnomer anymore, and it's probably lost. So probably need to lose that conversation. Most of them are because in 2019, the SEC finally came out with a rule filing for ETFs, and more importantly, they followed up with a derivatives rule, 18F4, and that actually permitted the use of certain types of derivatives in a certain type of way for the benefit of clients. All those products that come out with that type of structure, so that's outcome-based, other type products, income-based, using options to enhance yield, all those end up falling into the active camp. But I would say in some ways we're just scratching the surface, because there's a lot of interest, and now a person may like something, but they wish it had more yield, or they wish it had more downside, or how can we change that? And the use of derivatives permits and allows that. So I think you'll continue seeing many more exponential growth beyond what mutual funds had, because mutual funds weren't these like building blocks that you use for bigger portfolios. They were the whole solution. So
yeah, that's a great point, Ben. And when I started in the industry, aging 20 some years ago, it was like you're either active or either passive, right? It was very polarizing. And now it's like, doesn't matter. I mean, create a portfolio, that investors can achieve their objectives, whether it's active and passive SMAs, ETFs, you name it, right? Does it really matter? And you said it's like that conversation probably was so 1990, right? And it's time to move on past that, and it should be an inclusive discussion.
Yeah, Tom Dorsey, who's a kind of a legend in the industry with Dorsey, right? He used to always tell me people want the hole, they don't want the drill. And in some ways, active or passive is the solution, the hole people were looking for. Don't get into the mechanics of how I drilled it. Was it a cordless drill or a corded drill or by hand? And it's like, who cares? I need a 1/4 inch hole. Give me a 1/4 inch hole. And if I can get there by active, passive, or
Yeah.
some new, I don't care. Give me the solution. So
Yeah, you're exactly right. It should be now, more solution based, right? Just like you said, versus product based. And just as long as they get to their end goal, it doesn't matter how they get there, right?
right.
And that talks about risk too, that we'll talk about. Doesn't matter how much you fluctuate the volatility as long as you're on your path to achieving your goals. You mentioned defined outcome products, and now, SEC rules now allowed you to put options and derivatives inside ETFs. What's your view on these low or minimum volatility ETFs, whether you call them buffered or defined outcome products? They're really growing a lot out there. What's your thoughts on those?
Yeah, I think they're a phenomenal structure. I think they're very interesting. They provide a certain type of exposure for investors or advisors to be able to look. Um, Personally, one of my concerns is that it is probably in most cases more of a fixed income replacement tool
Mm,
than it is helping with volatility on equities.
okay.
And there's nothing wrong with that. I mean, that's a great area you need to do. That's why we spent so much time more looking at. But can we get to helping with the volatility on equity, since most individuals, that's a larger portion of their portfolio than the fixed income. But for fixed income, I think fixed income replacement, and I say that because most, not all, but most outcome based, you give up some or most of your upside in exchange for that, and that's what makes them look a little bond like. And but it's interesting. Hey, I applaud. I'm excited for the success that's happened there. I think it's given a new appetite, but also a new opportunity for advisors to manage risk and look. But I think they'll continue looking for other answers and other solutions. I'm sure. So
Yeah, and it's a perfect time to talk about risk and volatility because of all the uncertainty out in markets right now. Um, so what's your view at Webb's, your team, on trying to minimize risk? And it's a fantastic product, right? We talk a lot about having clients or investors be able to sleep at night, right? And a lot of that is risk mitigation or reducing risk. How do you guys go about reducing risk in your ETF products?
yeah, we've done a lot of thinking through this over the last 4 or 5 years as we've kind of worked and came up with this model. And the one thing, every once in a while you get these little epiphanies, and all of a sudden I was like, you know what? In the investment world and the 30, almost 40 years I've been in the industry, 30 years building ETFs, I began realizing in some ways we're like the caveman. I mean, we were living outside and we are having to deal with, hey, it's getting hot. We got to deal with, less skins on me, and stay cool. And then it's getting cold. I better keep the fire rolling. And I kind of feel like what we did with Webs was, let's move indoors, but let's jump all the way to, let's have a Nest thermostat that'll actually crank up the fire or cool down the house, but keep me in a comfort zone. Keep me in an area that I actually feel good about it. And I thought, if we can achieve that, now hopefully now we're not, because we've seen the numbers. Trying to time the market is brutal. It's almost impossible. And this type of market, where every day you do not know what's coming out of Washington and how it's going to change the direction geopolitically and across the board, and economically, and companies now having to move manufacturing plants, and you're starting to go, okay, that's not sustainable, but what do we do? And
Yeah.
and so, that's really the answer we tried to go for is let's provide a way that's systematized, it's there, and provides that, opportunity. And
Yeah. Consistency is so important, right? And whether it's consistency of returns or consistency of style, we talk a lot about that at Zephyr, is trying to find products that are consistent so you can sleep at night. So you know their role within a portfolio. It may not be the growth but if you have a consistent band or range that you're kind of sticking to and you can be relied on, it's a great product to offer, right? And solution for these investors especially during times like this.
yeah, I mean, our analysis and what we looked at, it's all these things. I was just shocked. I mean, in some ways, I started as a stockbroker. We still call ourselves that in the '80s. But volatility wasn't something you could really address. You didn't really talk about it, but you would talk about the aspects of volatility. Oh, I could do call overwriting and sell that volatility for income. And all these things are great, good tools to have. I launched the first buy right ETF. I launched the first low vol ETFs. I think in some ways, my whole career, I tried to figure out. I was a commodity trader in the late '80s, early '90s, and I think all of it was themed around volatility. And
Yeah.
now all of a sudden I'm going, wait a minute, what if we just set it up that we marry and we look at short-term vol, we'll say last 1 month vol compared to long-term historical vol. If it's lower, we can actually enhance our exposure. If it's above, let's reduce. So like in this market right now, we have what product on SPY, we have one on Qs. We're actually below 1x. We're about 0.77 exposure on
Okay.
Qs, and we're right around 90 on SPY. So even with the noise, we have less impact than what owning the ETF by itself. But at some point, capitulation happens, people get, fear comes out of the market, we'll actually enhance up and we could go up to a 2x exposure, but we're
Okay.
not a levered fund. Our goal is give us our North Star and for SPY, it's 20% volatility. And we go up and down, but try to smooth out that ownership. So, what, no matter what's happening, someone's overseeing my portfolio and delivering a better risk adjusted return. And
Hmm.
that's our goal.
We love talking about risk adjusted returns when the podcast is a take on that, right? So,
Exactly. Yeah.
fantastic. So you talked about your products like on SPY, and the triple Qs. How do you incorporate products similar to yours in a portfolio? Do you do it as a certain percent of your SPY holdings, or is it like just more of a satellite approach, core approach? How should a financial advisor approach including these in a portfolio?
Yeah. I mean, we build it to be a core holding. With
Okay.
that said, it's a new idea. It's not new to institutions. They've had access to products like this. But for retail advisors, it's new. So pragmatically, I sit there and think, what I don't put your big toe in the water, acquire some, or with the type of market we have, if you have some SPY positions that maybe you don't have a lot of unrealized capital gains on, and you can convert over. That's probably a good entry point because you kind of get to restart the meter and look. If you're a larger advisor, you call, there may be a way we can do what they call 351 exchange and you
Yep.
actually move all the positions in. But it's not rocket science what we're doing. It's just new and people haven't done it before. And they haven't done it because, frankly, the SEC rules were restrictive. But then I think most firms do not have the capability to. We end up using swaps in our portfolio. Very few ETF firms have the capability of swaps, and if they do, it's for trading
Hmm.
single stock, um, uh, pro shares and direction. But again, it's all for 1 day or very short term. We're for long term. We want 18, 3 year type of goal. If you've got a longer term horizon, we can almost give you certainty of how that looks. If you're saying over the next 2 months, what do I do? There's probably better things, to do.
Yeah.
So, we're built for long-term core ownership. Percentage wise, I'm sure it hits each, but tax is always, if I was sitting in the advisor seat, if this tax deferred account, I'd probably be a little more aggressive in making the move. But in a taxable account, you got to be sensitive to that.
Yeah.
I realize it. So
Yeah, fantastic answer. And it's interesting how just portfolio construction and one thing that I think in this innovation and products like yourselves and all the other different ETF products out there, it helps the client, right? Provide them with new, as long as they're not inundated and the financial advisor can, tell those stories and educate the individual, their client on what type of investment it is and how it works and what role it plays. It just helps the investor build more optimized portfolios to manage risk, um, which is really most important.
yeah, exactly. Well, that's what we're doing a lot of in our research lab, which we enjoy being in and talking about. We're looking at a lot of different asset classes. Um, anything that's long-term held by investors looking to say, hey, can we help? And sometimes it's greatly reducing the volatility of something that has a lot of volatility in it.
Mhm.
It's sometimes, you know, factor-based, a low vol, you might be able to actually increase a target vol because you're already, your beta is already below the market. So maybe you have almost a free trade in there. So let's look at it. So we're doing a lot of research and a lot of ideas. So I think as advisors hear this, they go, this is fascinating. Reach out to us. Maybe there's things we haven't thought of. Maybe there's ways we can work with them. At the end of the day, we build products because we know this is what's keeping our partners, the advisors, up at night. And so if we can help remedy that, that allows you to do what you do best in your business. And we're not reaching through to the end retail client. We're reaching to the advisor. Advisors are who we serve. So
Yeah, fantastic. Well, let's talk about risk real quick. You talk about volatility. As Zephyr, we do a lot of research on different types of investment risk, whether it's standard deviation, your typical volatility metric, or go a little bit further and talk about like drawdown risk. And we released the Zephyr pain ratio, which really focuses on limiting that drawdown risk. What do you feel is the most important risk or vital risk when looking at investments?
yeah. Excuse me.
No worries.
Yeah, it's actually it's an interesting topic. We build all of our products on standard deviation
Mhm.
risk. Some of it just because of the data and the information, it's there. We're in discussions with some of the ETFs, existing ETF sponsors, seeing that we actually utilize ETFs to do it, and they're looking more at upside downside capture and drawdown. And I think it is the next step. I'm confident it still works in that environment, but I will say that's uh, we looked at standard deviation to really start this path. But for them, we're actually looking at let's make sure we're maximizing both drawdown but also upside capture, and I think those type of things are phenomenal. And I don't know if we're prepared to answer it today, but I think we have the right tools, data. We've done so much research on our defined ball. I think making that pivot isn't that hard, but it probably does start changing things like um, we may introduce some, I'm quite confident our next series of ETFs we're launching may have more of a rolling volatility score because things change and they happen to be,
Mhm.
the file, people can see with the filings. But, if you start thinking of things that are more segmented, you know, those,
Yeah.
let's say it's industry group sectors, anything else, that product 20 years ago is not the same as the product today, and probably not what it'll be 5 years or 20 years from now. So I think we have to adapt and adjust and figure out. And I think those kind of fit hand in glove with what you're talking about, is that recognizing that, understanding it's actually doing some very interesting opportunities, and it
Mhm.
might be a little more, where I said that our original products, we are looking at the 18 to 3 year at least minimum. You might be able to shorten that up a little bit. You can say, hey, in the next 6 months, this is probably a good. Now we can begin looking at opportunities because it's a little more current on current. short term, but the long term is just, where we've been, especially right now, post COVID. We're getting almost to the other back. Seems like it still happened yesterday, but it's, as I was coughing, you probably thought it was. But I look and go, it's interesting. The world moves at such a fast pace that you have to go, we're almost into a 5-year numbers are almost post-COVID numbers. And it's like, oh, wow. Okay, that's a shift. And, we have to, what's the new world order today compared to
Yeah.
if we're in 2015 or 2009, on the back end of great financial crisis.
Yeah.
So very interesting.
It's crazy. You have been, like when you do analysis, it's like soon the great financial crisis, you go 20 years, that's going to fall off. And now, arguably one of the worst, depression or time periods in markets isn't going to be part of the 20-year number. It's going to make 20-year numbers look pretty good
Yeah.
moving forward, right?
Well, and I was born early 60s. And at the time, I remember when I was born, it was historic to hear about my uncles who fought in World War II, and you didn't think about it. I look now and I'm like, oh my goodness, I was born within 15, 17 years at the end of that war. I kind of relegated it as, the Civil War and then the World War II. And I'm like, the great financial crisis is further away further away from us than when I was born in World War II. And I never thought about that. That was
Yeah.
just, it's a mind bender when I go, oh man, that again, we can talk about Lehman and Bear Stearns failing, and yet you're going, I can remember, or, uh, terrible day, 9/11. I mean, everybody knows where they were with 9/11. 9/11. The amount of people in our industry that was just at that conference that were probably born after, that's all history book. You're like,
Yeah.
okay, the world changes, and we have to recognize, and that means we have new kind of volatility today. And
That's a very good point. And it's interesting how, people have been in the industry for what we can kind of relate to what's going on today. Nothing is really, what is it? History rhymes but doesn't repeat itself.
yeah,
You know, we look at today's volatility and, the cues were in a correction. S&P 500 is close. And we look back to, we experienced a great financial crisis and like, yeah, this is nothing. It makes it easier for us to stay invested when you
yeah.
can have some, we can compare it to other times that were worse.
Well, I always think back. I became an advisor mid '80s, and terrible idea. I was, like who in the right mind is going to give a 25-year-old their money? But I was an advisor, and I went through training, and I did all. And what happened was the market crashed '87. Options had really come out about just in '83. This idea of buy right on existing holdings and getting extra income is how I built my whole client book. You'd call a person to have, hey, you own IBM. What if I could generate income? And you'd go through this pitch, and people like, I can't even get a hold of my advisor. I don't even know what's going on. Yeah, I'll move my book. Let's talk about how to do this. I look now and I go, there's a lot of things that happen, but the one thing I always remembered afterwards was I would be call the clients, we can do this, but really you need to be buying the market. And this was within weeks of the market crash. You could not get a person to step back in the market because, what's going to happen next? And yet by the end of the year, we recovered all the losses of that day. And I think that's the theme that I kept thinking is, how do you keep an investor? How do you calm them down to go, investing is a long-term proposition. It's not timing. Timing is, we're not equipped for timing. I don't care who it is. If timing was so easy, there'd be so many billionaires out there that you wouldn't know. And so at the end of the day, staying invested is important. And that's really, somewhere between volatility in my head and let's keep people calm and invested for the long haul. I think that's, what was the old book? Stocks for the long haul.
Yeah.
But we have great indices out there. We have great ETFs already existing. All we're doing is saying, let us partner with you. Let us change the dynamic of ownership of those ETFs. So,
Yeah, that's a great point. The importance of staying invested, and it's arguably probably the hardest discussion a financial advisor has to make. But I also wonder if the education out there and awareness is improving, so it's easier now for the investors to understand the importance of it versus the great financial crisis or earlier when it was, I'm out 10% down, I'm done, you know.
I don't know, but look at the amount of money that moved into money markets last month.
Yeah,
Well,
that's true.
something I sit there and I go, that's not a great sign. People panicking instead of shifting and adjusting. And maybe it's not panic. Maybe it's some big institution, but usually money markets are
Oh,
indicative of investor sentiment. And you're like, I don't know. Let's keep them in. Let's answer the questions that we've never. What are the elephant in the room questions? Let's deal with those, not just play around the edges. So we're we're stepping into it and we like the discussions.
yeah. Ben, that's fantastic. And it's products that you guys are creating and putting out there to the marketplace that helps it make it easier to stay invested, right? And for these conversations. Ben, that was a lot of fun. Thank you so much for coming on the show, sharing great insights, some good stories. I'm always enjoy a good story. So where can our audience get more information about Webb's investments?
Yeah, so best way to start would be our website, WEBSINV, so Webs Invest, but websinv.com.
Okay.
Go there. My email, I'll even give you that, it's just bfulton at websinvest.com. We're a small firm. We're partnered with an old line a mutual fund firm, Westwood. They handle our distribution, and we're a joint venture of theirs. So we love the Westwood team sitting in Texas, and they have wholesalers around the country. So if you know your Westwood wholesaler, they'll know about Webs. But you can come to us, and we'll get you the other direction. At the end of the day, we're one big family. So that's great.
Awesome, Ben. Fantastic conversation. Great insight again. Thank you. It was an honor to have you on. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week. Ben.